On June 12, 2026, Space Exploration Technologies listed on the Nasdaq at $135 per share, raising $75 billion in primary capital. A $1.77 trillion valuation makes SpaceX larger than Meta and Tesla. It effectively matches the entire annual gross domestic product of Australia. SpaceX's public identity is built on the mission to Mars, the starships, the orbital maneuvers, and the heavy lift logistics. That profile carries a 94 times revenue multiple based on the $18.7 billion in 2025 sales. In 2025, SpaceX reported a GAAP net loss of $4.94 billion, pushing its accumulated deficit to $41.3 billion. Yet they allocated 30% of the float to retail investors, 3 times the standard. This structure targets individual traders motivated by the colonization narrative and the fear of missing a generational market entry. Institutional desks, however, are pricing a corporate structure that has little to do with the legacy aerospace industry. To understand the 94 times multiple, the SPCX ticker must be viewed as 3 interdependent businesses: connectivity, space, and artificial intelligence. Starlink, categorized as the connectivity segment, provides 61% of the company's total revenue. This division generated $4.4 billion in operating profit in 2025. It is the only portion of the SpaceX conglomerate that currently generates a profit under GAAP. Subscriber growth is aggressive, doubling to 10.3 million users by Q1 2026. But unit economics are shifting. Average revenue per user has fallen from $99 to $66. Continued growth requires expanding into emerging markets and discounted hardware plans. Serving more users at a lower price point strains existing infrastructure. Without a bandwidth upgrade, internet speeds for the 10 million user base will degrade. Solving this massive capacity crisis requires the next-generation V3 satellites, which deliver 1 terabit per second of throughput. Starlink's cash flow stability is tied to the successful deployment of these V3 units, tethering the telecom business directly to the space division's flight schedule. The space segment reported $4.1 billion in revenue and a $700 million operating profit for 2025. While the legacy Falcon 9 is the industry standard for reliability, its payload fairing is physically too small to carry the massive V3 Starlink satellites. The V3 constellation is entirely dependent on the Starship launch system for orbital delivery. In 2025, SpaceX achieved 5 Starship orbital launches against an internal target of 25. This shortfall creates a logistics bottleneck. Delayed Starship flights prevent V3 deployment, which stops Starlink from offsetting its tightening revenue margins. Developing Starship has cost the company over $15 billion, creating a significant drain on the cash generated by the satellite business. For public markets, Starship is the critical supply chain constraint currently limiting the growth of the company's only profitable division. The absorption of xAI in early 2026 introduced a new financial profile to the S1 filing. The AI division reported $6 billion in losses for 2025, followed by a $2.5 billion loss in the first quarter of 2026. The capital expenditure for this segment radically dwarfs the spending for both the space and connectivity divisions combined. This spending is driven by the construction of the Colossus data centers in Memphis. Operating this scale of infrastructure requires 200,000 NVIDIA GPUs and massive high-density power and cooling systems. Maintaining these infrastructure costs without immediate revenue would threaten the solvency of the entire conglomerate. The S1 prospectus includes a finalized compute agreement with Anthropic to address this cash requirement. The contract is worth $45 billion in total value, providing SpaceX with $1.25 billion in recurring revenue every month. This guaranteed inflow through May 2029 stabilizes the capital expenditure requirements of the AI build-out. The xAI merger allows SpaceX to use the Colossus infrastructure for its own models, while renting out the excess capacity to external partners. SpaceX is an AI hyperscaler. It is an infrastructure monopoly, priced on power, cooling, and chips. A $135 share price requires a high wire act across 3 disconnected industries. Success depends on simultaneously scaling a global telecom network, hitting Starship flight targets, and maintaining AI infrastructure margins. The first major catalyst for public investors is the Q2 earnings call in September 2026. This report will provide the first transparent data on whether Anthropic revenue is effectively offsetting the Colossus infrastructure burn. The balance sheet also carries a $20 billion short-term bridge loan that must be repaid or refinanced within months of the IPO. A separate structural risk hits the market in December 2026, when the massive 90 to 180-day insider lockup periods officially expire. Early employees, venture backers, and the 21 underwriting banks will all be eligible to sell their private equity at the same time. Retail investors holding 30% of the float face a significant supply shock if institutional insiders choose to liquidate their positions. Rockets and satellites are the industrial scaffolding for a $1.77 trillion artificial intelligence empire.